Hey everybody, how you doing? We'll get started here in just a minute. Looks like some other folks are still signing on. While we wait, just so you know, this is a Zoom webinar, not a Zoom meeting. So your cameras and microphones are not enabled for this, just the presenters, just to make sure you understand that. And then also, if you want to interact, you can. There's a Q&A button down at your screen, the bottom of your screen, and you can type in questions or comments as we go along in the presentation. We'll get started here in just a couple seconds. Still a few people signing in. All right, let's go ahead and get started. Thanks for joining us today. Welcome. Hope you're having a great day. Hope you and yours are well. I'm a financial advisor. I've been doing it for about 20 years, so I'm just starting to get used to it. But what I love about it, what I'm honored, why I'm honored to be a financial advisor is I get to help people reach their goals, their financial goals. So it's really humbling, and it's fun to see folks reach their goals. And if I can be a little part of that, it's really rewarding. And what I like about our human or mankind, I guess, is that we all have our own areas of expertise. Have a mechanic or a plumber, electrician, an attorney, an accountant. Everyone has their own areas where we help each other out. We can all work together. One example, I have a client who's a successful businessman. He owns a heating and air conditioning company. And he has said, Tim, I'm just stupid when it comes to this, but I'm stupid when it comes to what he does. If I were to try to fix my own heating and air, I'd make way too many trips to Home Depot and have to watch tutorials, and it would take me way too long, and it wouldn't be done as well as it is when his company comes out to do it. So again, we all have our own areas, and I'm just honored to have this be part of mine. And as we talk about investing today, the five truths of investing, I think it's important for us to keep in mind that we have all this information coming into us from all different sources, cable news, social media, whatever it is. And a lot of it's negative. It's negative information, and it promotes fear. And in investing, two emotions that we need to avoid acting on is fear and greed. And fear or greed is outside of the bounds of wisdom. And today I think we're going to talk about some things that are in the wisdom category in these 5 different topics. So I'm interested to see if you have any comments or questions about these as we go through them. So we'll get ready to start the presentation, but wait, before that, let me be like Vanna White here. We have, for whoever's participating, I'm going to mail some of these mugs out. They're mirror mugs that keep your drink hot or cold. And what I like about them is they're a generous company, and they donate money to different causes for each mug that they make. So on the bottom, there's a code where you can go online and see what was donated to for the mug that you receive. So if you're clients, obviously I have your physical address and I can mail these out to you. If you're not a client, my email will be available at the end of the presentation, and you can just email your physical address to me, and I'll get these out in the mail to you. So without further ado, we have Sean Morgan here from Eventide. And Eventide's a company that I use regularly. Many of my clients would be familiar with them. A lot of clients would have Eventide on their statements. And I'm just happy that he's here today to help with this presentation. So take it away, Sean.
Thanks. So I want to start by saying this. If you've sat in on an investment presentation before, I want to compel you to not judge a book by its cover, and but be prepared for some entertaining anecdotes throughout this presentation that are going to be memorable. So the things that we'll cover here are very important. They're the timeless truths for investing. These truths that we all need to remind ourselves of, especially in market conditions like we're seeing today. But I want to compel you to say, I think we're going to do it in a little bit more memorable way. So this is the least entertaining slide on this deck. This is me, my background. I've worked for a number of different asset managers before choosing to seek out Eventide to work for, just because I believe in their mission. Now, I need to say this also before we begin. Since the nature of this presentation is talking about investing, I need to let you know that this is not actual investing advice. So do not take this as investment advice. Always seek out someone that knows your particular situation to give you advice for your portfolio selections. Don't rely on this presentation for that investment advice. So I want to start by sharing with you some headlines from a very prominent investment publication all over the course of 2020. So just last year, all these headlines are from that year. And we'll start in January, where the headline reads, "The Method Behind the Melt-Up, Why the Dow Won't Stop at 30,000. So this, of course, is a very bullish, a positive headline for markets, making the case that this upward momentum that we were seeing at the beginning of 2020 should continue on. Now, I want to share with you the next headline in March of 2020. So just a short time after that first headline, the COVID kind of came along, rocked markets. So we see this headline here on March 23rd, same newspaper. "What Washington needs to do right now to spare America from a second Great Depression." How drastically different is that headline from the headline we just read? So now let's move on to April. This is just 1 month after the last headline we read. April 27th, this headline reads, "In the stock market, anything could cause the next panic." So we've already seen a little bit of recovery at this point. If you remember, we had just a really sharp downward trajectory and then a really sharp recovery. And so this is as the market is recovering, but people are still nervous. They're saying, well, what could cause the next panic? So we're not entirely sure here at the end of April. Now, we're going to go all the way to the end of the year. And after a year of turmoil and uncertainty, all throughout 2020, this is the conclusion. December 21st, 2020, the S&P could gain another 10% next year. So if you were to read the first headline back in January, close your eyes, then open them back up in December, you'd be reading a very similar message. Now, I know last year was extraordinary, but if you're one that follows the financial news at all, this kind of up and down whipsaw is pretty normal if you're following it on a day-to-day basis. So it's more normal than what you would think, even though last year was an extreme year. So it begs this question here. How should we think about investing in the market? This is like, what should you do with your portfolio? Like, what kind of investment decisions you make? Is now a good time to invest? Was the plan I made a few years ago still relevant today? So I want to answer this question. How should we think about investing in the market? And in order to gain a better perspective, I want to take a step back from the headlines and consider these timeless principles. We'll call them the timeless truths of investing. So for the sake of making this presentation memorable, like I said we would, I've given these principles some catchy titles, and they each teach us something important about investing in the market. So first one, keep your eye on the owner, not the dog. Number 2, restrain yourself. Number 3, employ a system that forces you to buy low. Number 4, remember the most powerful force in the universe. And number 5, invest in businesses, not in markets. So we're going to go through each one of these one by one, and I'm going to teach what they mean, and hopefully you'll remember them. So we're going to start with the first one. Keep your eye on the owner, not the dog. What in the world? What does this have to do with investing? Well, it actually comes from a quote from this very well-known investor, Ralph Wenger. So Bill Bernstein actually shared this conversation that he had with Ralph in one of his books. So here's the quote. He likens the market to an excitable dog on a very long leash in New York City, darting randomly in every direction. The dog's owner is walking from Columbus Circle through Central Park to the Metropolitan Museum. Now, at any one moment, there is no predicting which way the pooch will lurch. But in the long run, you know that he's heading northeast at the average speed of 3 miles per hour. What's astonishing is that almost all of the market players, big and small, seem to have their eye on the dog, not the owner. So hopefully you get the analogy here. If you're paying attention to the owner, the person walking the dog, you see him walking directly northeast, just at a steady pace. You can anticipate where he's going. But if you're watching the dog, you'd be really confused because he's darting side to side, kind of as he's headed in that same direction. Now, I'm going to put this into charts here, just in case you're not making the connection with investing. So this chart actually shows the returns of the stock market all the way back to its inception in 1871, back where it begins there on the chart. Now look at the blue line. This represents the stock market performance with all of its ups and downs. So you can see it's kind of it darts up and down a little bit. In the metaphor, this is the dog. So this is the dog that's darting from side to side, very confusing, somewhat erratic pattern. Now, the yellow line represents the best fit line for the data, like the average out version of what the stock market does. And you can see that it's a pretty good fit. It's a straight line. There's no curvature to it. So in our metaphor, this is the owner, the person walking the dog directly north and to the east, translating to this chart as up and to the right at a steady pace. In this case, averaged out over time, it has been a pretty steady pace of about 6.7%. for 150 years. That's what the stock market has done. If you average it out and take a step back, 6.7% for 150 years. This is remarkable. It's very steady and very predictable. So our task here as investors is not to be so consumed with what the dog is doing, which can be confusing and misleading, but rather you keep your mind on the long haul, what US businesses are doing in the economy for the long-term strategy. This is the owner, not the dog. Just remember that keeping your eye on the owner keeps best for a long-term strategy because you know ultimately where it's going. So, all right, let's move to the next point here. Restrain yourself. Now, it sounds like I'm going to get a little personal with you, and indeed I am. I'm going to get very personal with you. We need to reckon with something inside of us in order to be successful. So I want to introduce this to you by showing you an article here from the Wall Street Journal. So we're going back in time. As you can see, this was published, the date there, December 31st, 2009. So every decade, the Wall Street Journal crowns a king of mutual funds for different investment categories according to the fund's performance for that past decade. So they look at the fund's performance and they announce a new king. So what you're seeing here at the end of the first decade of the 2000s is the coronation ceremony for the king of mutual funds. And you can see here that the winner of the diversified stock mutual fund category had an annualized return of 18% over the past decade, beating the next closest fund by 3%. So that fund, as you can see, was called the CGM Focus Fund, 18% average return. That is a pretty good return. Now, what I want you to take away is this. If an investor had invested in this fund right at the beginning of the decade and stayed in it the entire time, they never pulled their money out and they never tried to time it to get it back in, they would have received an average 18% return every year for 10 years. So I have this question for you. What type of return do you think the average investor who invested in this fund over that decade received? So you're probably assuming that at least some of the investors didn't stay the course the entire decade. So some probably got fearful when the fund was down, they pulled their money out, and then some tried to time it right and invest whenever they thought it would go back up. But at the same time, you're probably thinking that some people got it right and were able to time things appropriately, and they might have completely avoided downtimes and took advantage of the good times. So you might be thinking it's a wash. So the question is, what do you think the real average return for investors was over this time? Get it in your head. What do you think? It was not 18% per year. I'll tell you that much. the average investor actually lost money. Look at this here. So too bad investors weren't around to enjoy much of those gains, talking about the 18%. The typical investor in the CGM Focus Fund lost 11% annually in the 10 years ending November 30th. That's crazy. So most investors actually lost money while they were trying to invest in a fund that was very successful. So how did this happen? Well, the article explains. Look at it here. These investor returns, also known as dollar-weighted returns, incorporate the effect of cash flowing in and out of the fund as shareholders buy and sell. Investor returns can be lower than mutual fund returns because shareholders often buy a fund after it has had a strong run, and then they sell as it hits its bottom. That is the reason why investors lost money. So this is what happens. Investors are shopping for a fund. They say, oh, look at this fund. It has a really good performance, and I'll invest. So then a few months later, if the fund is not performing as well as it had, they get nervous thinking they picked a dud, and then they sell out of the fund whenever it's down. Then the fund starts performing well again, and the investor thinks, hey, I want back in. And the cycle continues. So investors are actually buying the fund whenever it's high, and then selling the fund whenever it's low. Thus, the average investor is actually sabotaging their own returns through their emotionally driven behavior. And this is actually really common. So I want to share with you a book on psychology. This has been a very influential book, so you might have heard of it. It was written by Daniel Kahneman, and you can see below his name here on the screen that he won the Nobel Prize in economics. So the premise of this book is that it is easier to recognize other people's mistakes than your own. This is classic psychology. So it's easy for us to look at the shareholders, for example, in the CGM Focus Fund, and point our finger at them and say, oh man, they got it wrong, but I wouldn't do that. But we really have to look honestly in the mirror. It's not just the investors in the CGM Focus Fund, it's most investors. So what we're looking at here on your screen now is the performance history over 20 years from 1999 to 2019 of different asset classes that you can invest in. So on the far left here, starting way over there, that first gray bar, those are REITs, or real estate investment trusts, which are funds that invest in real estate. So you see that they averaged about 11.6% per year. High yield bonds average 7.9%. Here in the green, you have S&P 500 bringing in pretty close to its average over 150 years at 6.1%. The light blue mix there, that light blue bar, it's a mix of stocks and bonds. It averaged about 5.6%. Bonds by themselves, about 5%. The value of homes, a little bit further over, that 3.4%. Inflation was about 2.2%. Cash 1.7%, commodities 1%. Now look at that orange bar there. This is what the average investor, up to their own devices, this is how they did. They underperformed virtually every possible investment category, meaning they didn't even have to pick the best category. They could have picked almost anything and just stuck with it in order to receive better results than what they actually did. And we have to reckon with this. Our own behavior is what causes us to underperform, because we love to chase a hot return and we get scared and give up whenever things are down. This is what causes us to underperform. So I love this quote from Morgan Housel, who says, finance would be better if it was taught by the psychology and history departments at universities. I couldn't agree more. Here's a quote from Warren Buffett's partner, Charlie Munger. The big money is not in the buying and selling, but in the waiting. So here's the takeaway. When you invest, you need to turn off that switch in your brain that causes you to emotionally respond to immediate circumstances. Just like we were talking about the ups and downs of the market by those headlines, that causes an emotional response, and we want to act on that. The most successful investment strategies, however, they involve patience. And we'll touch on this again in just a little bit. So let's move on to number 3. Employ a system that forces you to buy low. So we just talked about how detrimental it is when you buy things when they're expensive, then you sell things when they're cheap. So it would be helpful if we actually forced ourselves to do the opposite, to buy low and sell high. So a remarkable concept. So let's go through an experiment here. This is a systematic way to doing this buy high or buy low, sell high proposition. So let's suppose you are dropped into history anywhere between 1920 and 1979. You must invest in the US stock market for the next 40 years. You're earning an income from your job along the way, and you have two strategies to choose from on how to invest the money that you're earning. Option one, you can consistently invest $100 every month, no matter what, over 40 years. So no matter what the market is doing, you just take $100 from your income each month and add it to your investments. So that's option one. Option two, you have the option of every month you put $100 aside and only add that money to your investments when there are dips in the market, meaning most months you are not adding to your investment account. That $100 a month is just sitting in cash. And you might build up $800 or $1,500. And then when the market drops, right before it goes back up again, you invest all that cash that you had been building up. So let me say this. No one in real life has actually proven themselves to have perfect knowledge of when the bottom actually occurs. You just don't know when it's at its lowest and about to go up. But for the sake of this experiment, I'm going to grant you, with option two, I'm going to grant you the perfect knowledge in real time to sense when the market truly bottoms before going up again. So the question is, which strategy would you choose? Now, let me make a comment here. You are probably thinking that this is an odd experiment, but it's very relevant because some people are always trying to time the market, and some people just have this consistent strategy. So this experiment was actually performed, and they compared the results between the two. And this chart's a little confusing, so let me tell you how to read it. So every point in time that this blue line is above the dotted line, you would have been better off buying the dips. So there are indeed times, specifically in the 1920s, that the buy the dip strategy would have underperformed. And that makes sense because you would have saved up your money and might have missed out on some opportunities in the roaring 20s, but you would have invested all right at the bottom of the Great Depression. So that would have been fantastic if you would have missed that dip for the Great Depression. So now look here, if you would have started these two strategies at any point after 1940, you would have always been better off consistently investing $100 every month rather than waiting and only buying the dips. So 70% of the time, monthly investment outperforms. Now, here's the conclusion here. So monthly investment outperforms buy the dips 70% of the time. So odds are in favor of option one of constantly investing the $100. Now, remember that in option two, I granted you a tremendous power, one that no one actually has, the flawless real-time awareness of when dips are occurring. This is just impossible to do. So let's make this just slightly more realistic and see what it does. So what happens if we slightly decrease this superpower to only have a general guess? So let's get it. Let's say that you get it wrong by just 2 months, and then you crunch the numbers on the experiment. If your superpowers are a little more in line with like the abilities of everyday humans, you would actually underperform at 97% of the time. So how could this be? Well, the idea is to buy low, right? And this is ultimate of buying low. So you waited and you timed it right. You should win. But there seems to be something magic about investing monthly. But it's actually not magic. It's a strategy, and it has a name. It's called dollar cost averaging, and it's very simple. It's investing a fixed amount of money at regular intervals over time. So the easy example is $100 a month, but the amount can vary, the frequency can vary, but the concept is the same. Set it and forget it. Just keep on doing it. So by investing a fixed amount of money, the strategy buys more shares of an investment whenever the prices are low because the shares are cheaper. That's how it works. Your money can buy more if there are cheap shares, and then it automatically buys less whenever the prices are high. So you can't buy as many shares whenever they're expensive. So it forces you to constantly be loading up on shares whenever stock prices are low, and then buying less shares whenever it's high. So let's show this using real numbers. This is the S&P 500 from the year 2000 to 2010. It was a very tough year to invest. So we had the dot-com bubble and the financial crisis. We also call this the lost decade in investing because 2010, the market is actually down 24% compared to 2000. So it's pretty depressing. Many people say this was the hardest decade to invest in history. So how would dollar cost averaging do during this decade? Simply by investing in the S&P 500. We'll take a look here. You can see on the top, that is the same image that I just showed you. We just shrunk it down, put it up on the top there. But the graph on the bottom shows you how many shares you are picking up along the way by investing a fixed dollar amount. In this case, we're using $500. So you see it works exactly as I said. When the market is peaking, your $500 can't buy as many shares because they're too expensive. Now, when the market is down, your $500 is able to buy more shares. Notice that this strategy is a buy the dips strategy in disguise. So every time the market dips, take a look here in 2009. You see 2009 there? You're buying more shares than you were whenever it was high, but you weren't even trying. You weren't even thinking about timing in the market. It's just built into the strategy. With this strategy, your return would not have been negative 24%. Your return would have actually been a positive 5.9% over that period. So here's an unlikely quote from an investment presentation. This is Napoleon. He says this in regards to military genius, but I think it's regards to investing genius too. The man who can do the average thing when all those around him are going crazy. That's what he's talking about with the genius. No doubt, dollar cost averaging might be pretty boring, but as we saw, it can be a genius strategy. So number 4, let's go for number 4. Remember the most powerful force in the universe. Well, what is this force? Let's ask Einstein. The most powerful force in the universe is compound interest. What is he talking about? Well, I'm going to give you an experiment. It's a famous experiment. Many people are familiar with it. It's called the very expensive cup of coffee experiment. So let's say that you purchase a cup of coffee every day for $3. And one day you decide to no longer purchase this daily coffee. And instead, you're going to invest that $3 every day. So after 40 years, how much would you have? Let's use that historical growth rate that I showed you earlier in the presentation of 6.7%. How many of you think that you would have over $50,000 or $100,000? Well, the answer is, remember, $3 a day, 40 years, $215,000 because of compound interest. So what is compound interest? I'll try to make this very simple. Let's ask Ben Franklin. Money makes money, and money that makes money makes money. And the money that's making money makes money. That's how compound interest works. It's very profound. So let's make it concrete by looking at the math of the coffee example. So instead of buying coffee, you save that $3, which is $1,095 a year. At a growth rate of 6.7%, your $1,095 would have grown to $1,168 after year 1. After year 2, you add another $1,095, which is added to the $1,168. So now you have $2,162. And that whole amount, again, grows by 6.7%, which then gives you $2,415. And it keeps going like this. And so building up over time, you see catastrophic, and I say catastrophic in a good way, catastrophic results. So this is what it looks like. The yellow line is what $3 a day looks like if you were to just save it, just put it in a savings account. The blue line is if you invested that $3 a day. What I want you to notice is that this upward sloping line really starts kicking in around year 20 and then keeps skyrocketing. And this is the power of compound interest. So notice how humble it is in the beginning, but as your money starts making money and then that money starts making money, you'll see its real power over time. This is a little bit more realistic example for someone maxing out their IRA at $6,000 a year. Same concept applies. This is what we call the everyday millionaire. So it's a very powerful force. And it works because time is on your side. Yes, it is. Thank you, Rolling Stones. And here's a quote from Warren Buffett. The stock market is a device to transfer money from the impatient to the patient. A very true quote from Buffett. So we've gone through these 4 truths. Now we're on to the 5th one. And this is a very important one. Invest in businesses not the market. So many people have lost sight of the true purpose of investing. And I want to remind you of that here. So it's long been divorced from its original and most basic purpose, supplying capital to businesses. So how do most people think of it? Many people are trying to profit from the market itself rather than from any productive and intrinsic value of the underlying companies. And what happens as a result? When this company or ownership perspective is lost, our relationship becomes all about performance, which means we chase the ups and downs and the rises and falls of the market. And we feel great whenever the market is up, and we feel bad when it's down. And you're not the only one that feels this way. It's universal. So this is William Cavanaugh. He's a professor at DePaul University. He says, retirement accounts tend to just go into mutual funds, where not only do I not have any idea how the companies that I have stock in are being operated, I also don't know what companies I have stock in. And they're run by an elite of managers whose one preoccupation is with increasing the bottom line. So I imagine that as an investor, at one point you say, what am I actually investing in? Where is my money going? What am I actually profiting from? And these questions, a lot of times, are difficult to answer. And we in the financial industry, particularly those of us managing funds that you're investing in, we have not made it much easier. So this is a quote from Cliff Asness, who is the managing and founding principal at a very large investment company. Actually, I heard him speak at an investment conference once a few years ago, and he said this: I pride myself on not knowing what's in our portfolios. So here's a guy whose job it is to invest in companies on the behalf of his clients, and he's saying it's a point of pride for him to not know which companies he's invested in. Why? Well, he's a numbers guy. And if you got the right combination of numbers and metrics, that's enough for him. So on the one hand, this takes incredible amount of discipline to execute this process. But it also removes himself from the original purpose of investing, which is that business connection. Whenever you are investing in a company, you become an owner in that company. So I want to remind you that when you invest, you're actually investing, when you're investing in a mutual fund or an ETF, you're investing in companies themselves, which is why you should also consider your values and the values of the company, since you are indeed, as an investor, an owner in the company. And this is just how it works. You have this ethical responsibility conjured whenever you are an investor in the company. And since investing is company ownership, the first and most basic questions of investing should be ownership questions. So as we look at a company, we should ask more in-depth questions, like how a company is managed and how they treat their stakeholders, their customers, their employees, their suppliers, their communities, their environment, and society more broadly. And here's some questions that we like to ask, just to get you thinking. What would we want to work under this leadership team? How likely are we to recommend their product or service to a friend or colleague? Would we want our son or daughter to work at this company? On a scale of 1 to 10, 1 being a new flavor of gun and 10 being a cure for cancer, how much value does the product bring to humankind? If we walked into a supply center, would we be proud of the quality of the working conditions? What would our reaction be if this company opened an office in our neighborhood? What about a supply center, a plant, or a factory? And does this company's environmental policy and actions leave a better planet for our grandchildren? Here's the thing: if we see investing as just the market, these questions don't really make any sense. But if we remember that investing is ownership in businesses, these make all the sense in the world. And here's the last quote of the presentation. I'm about to wrap up, but this is from our Chief Investment Officer here at Eventide, Finney Curvilla. He says this: many people have had the experience of purchasing a stock, becoming nervous as it declined, and then selling out at a loss, perhaps only to see it go right back up. On the other hand, if a person knows the business the stock represents and trusts the management, and so comes to believe in the company, these declines are not so troubling. That person is confident. He's a confident investor because history has shown that great businesses not only endure downturns, but they emerge even stronger, making these declines attractive points to invest further. Now, when you understand the merits of the companies in which you invest and better appreciate what you own, you can transcend a mere chart-based financial relationship in investing. you can have greater confidence and less stress because you're not buying mere paper or derivative, but quality businesses that you know and trust. After all, life should not be spent staring at a computer screen, watching ticker gyrations, but instead free from needless stress. And that's a quote from our CIO. So one last time, I'll recap the 5 timeless truths of investing. Keep your eye on the owner, not the dog. Restrain yourself. Employ a system that forces you to buy low. Remember the most powerful force in the universe, and invest in businesses, not the market. And that's at Eventide, what we call investing that makes the world rejoice. I'll turn it back over to Tim.
Thanks, Sean. Appreciate it. So it is easy to forget that we're investing in companies when we're in mutual funds. It's important to be, I guess, aware, for me at least, to be aware of what companies are inside of those funds. It's not just a fund, it's companies that we're investing in. So thanks for that presentation. My contact info is on the screen. Again, for the mugs. If you're not a client and I don't have your address, just email me your address and I'll send a mug out to you. If you're a client, I'll get one out to you. And if you have any questions on anything, please feel free to email or call. And if it's about time for your review, my office will be reaching out to you to set that up. So thanks so much for joining us today. I hope you have a fantastic day. This will be available on the website for replay in about a week or so. So if there's someone you know who may sometimes give in to fear or greed, I think we all do, feel free to forward them that link. I'll get that emailed out to you in about a week or so. So thanks for joining us. Have a great day and see you soon.